Good evening, everybody. Welcome to your Inner Circle special session today. Of course, we're doing it on a Monday rather than a Wednesday. That's simply because you'll be doing other things on Wednesday, my guess is. So I hope you don't mind the switch. And welcome to those of you who can't regularly make it or haven't regularly made it to Inner Circle. We run this every week with a trading topic and a deeper dive on it. And as well as that, of course, we have a quick look around about markets and see if there's anything we can see that may be interesting. So very familiar names and lots of not so familiar names. So whether you're an established inner circler or whether this is your first time or close to first time, you're very, very welcome. Just a quick little message just to remind you, this is for educational purposes only. Please make sure you do your own due diligence on everything you see here. Make sure that you follow trading plans. Make sure you manage risk on every trading action. And of course, what we're about today is this is a regular in between Christmas and New Year session. I invariably mix it up a little bit, but this time of year is important in terms of looking back a little bit to see what happened, where we were, how we did, and of course, putting some things in place in terms of plans of action to take things to the next level. So my job here is to turn this question mark into an exclamation mark, okay? There's no reason why any of you here can't make 2025 your best trading year ever. When you look at 2025, doesn't matter how you slice it, but what I want to get through is a message that do you really know that with everything that is you as a trader, the absolute unadulterated power of an image like this. So this is a simple entry following a Bollinger Band breach, and then we'll close it down once it's moved through here, hit a profit target, same thing here, close it down once it goes above that midline, hits a profit target. If you've got a system that says I do A, I do B, I do C, and then to get out, I do X, I do Y, I do Z, and these are equally balanced and they're followed through, that is powerful. The chances are that around about 80% plus of you don't do that. You may have the best trading plans in the world, but the reality is there's these little devils that pop on our shoulder every now and then and just say, hey, why don't you do this instead? Or it's going to go behind, so let's stay in. Or you can't go broke making profits, so let's just take it off now, don't let it run. We need to get out of our own way. But you do need to do some work. You do need to do some work to harness that power. This image here is nothing new to many of you. And here's how it works. If you are aiming for reliability of results, i.e. consistency in what happens, you need to know what to work on. We all see the same markets, and we all want outcomes which are better results. Or we may get results that aren't better. We may get results that are disappointing. We may get results that are worse. But if we look at the response that creates these, it's three things, and it's all in your head. So how you interpret this market action, what systems you've got in place, and what decisions you make based on those systems. Do you follow it or not follow it is the first one, of course. And these three things are all absolutely and totally in control. The only thing that isn't in control, you aren't in control of, is the market action. And of course, we develop in these three IQs, so market IQ, system IQ, decision-making IQ. We continue to develop in each of these as we grow as traders. So it's not to do with experiences per se, it's to do with doing something with the experiences. You can't continue to do the same thing and expect different results. So if your results haven't been great, or you think your results could be better, then if you believe that this is correct, then you are in control of the results you get. You are in control creating the 2025 you actually wanted. But you've got to do the work at the front end to get the results on the back end. Yes, exactly, Gunnar. No matter which way the market goes, it gives you many opportunities to profit. But you've got to be in the position to make that happen. If we look at how we refine our trading, remember it's all about doing the right things consistently. We make a plan to make ourselves better. We put a plan in action. We measure our plans and then we refine it accordingly. It's not rocket science in terms of a process, but it does require application. It does require some commitment on your part to make it happen. It's not a game. It's not a hobby. It's a way of creating choices in the life ahead of you. So what you've done to date and the amount of experience you've got is not so important. It's simply brought you to where you are right now, okay? The trader you are now is a reflection of what you've done to date. So what really is important in 2025, and incidentally at the end of this session, is what you do next. So as we go through, some of the things I'm going to talk about aren't complex. You may already know some of them, but knowing isn't doing, is it? And I am making assumptions about where you are now. I am making assumptions that you have some seriousness, otherwise you wouldn't be here on the 30th of December listening to me bang on. You've obviously been trading for some time, and my guess is you want to make things better. So what's the alternative to putting some things in place? You can answer in the questions box if you want. Tell you what, we'll offer the challenge. Let's make it personal. What's your alternative? If you do nothing different, are your results going to be any different? If you do something, do you have the potential to make your results different? That's what it all boils down to at the end of the day. So as we go through these 5 things, what I want you to do is make a judgment on where you are now. Does that resonate? Does that seem like it might be something you could work on? Does it seem like that might be something that I was putting this together and I was thinking, okay, there's a couple of projects in that we could work on as a group. How's about that as a concept? Okay, let's do number 1. Okay, so the number one thing is get your core components in line about how markets function. Many of you heard me talk about, on many occasions, the 7 ways a market moves. And these are quite simply, if we look at a chart, any chart, okay, and let's put it on let's leave it on an hourly chart. Okay, so if we look at this, we're either in downtrend, we're in uptrend, we're in reversal, we're in congestion, where it's sideways trending, and then we have a congestion exit. When we are in a trend, we often get trend pause and then trend continuation. And those are your ways the market moves. It's really that simple. So if we look at another chart, let's look at the Aussie, let's look at the Euro Aussie since we're looking at it before. So what are our entries? What systems, what strategies do we need to have in place that say this is a new trend, we want to be part of this? Number 1 is reversal. So have you a strategy that trades a reversal? There's your reversal. Have you got a strategy that says this reversal is now complete? I'm now in on this candle with my close in the bottom third, with my higher volume, and with my lowest close in 6. 2 is, have we got a breach of a congestion? A congestion exit or a breakout trade that says, right, have I got a strategy that does this well? It's close to the top third. We've got high volume there. Back to why I'm mentioning that. Strategy 3 is trend continuation. Interestingly, if we were to trade this, which looks a bit double bottomy, as a reversal, and we trade this to the upside with potentially a plan to potentially take profit or potentially trail a stop at this point, to get rid of these drawings, then what we've got here is essentially a really nice example of a retracement and then trend continuation. Now, people try to trade this. Why would you do that? Why would you do that when it could go back up to here and then down there? You've got a double top, you're done. Okay, what's the high probability trade on this? The highest probability trade is there's your previous swing high, there's the retracement, there's a breach of that previous swing high. That's not complicated. Have you got a strategy? Long and short. Are you trading with the trend? Like I before, look for, okay, so it's really quite simple. You want to know whether your trade's high probability or not, then you look for one that's got higher lows and higher highs if you want to trade long. How do you know this is over? Because you get a lower low, not a higher low anymore. Is that hard? Is that rocket science? Is it part of your plan? So 3 key strategies for making money from how a market moves. Reversal, bounce, I guess, trend continuation, and breakout. You should have strategies for all of those things. If you can't, there is priority 1 for you from right now. And of course, that's all based on this simple thing called price action. And I already referenced, what's the candle structure like? Is that candle a good candle? Well, yes, it is. It's closing the top third. It says, well, hey, look, we've got some. We'd rather that than not. And every time we've tested on the 100 or so EAs we've had on live forward test, every time we've done it without a candle that closes in the top half at least, it's not done particularly well in terms of win rate. It's really important. So start with the price, the anatomy of the price action you intend to take, not an indicator. We're not looking for a moving average cross. We're not looking for that Bollinger Band idea is a really good one, by the way, but it's a reversal, and we're using an indicator to help us identify that reversal easily. So what's the price action? And as I said, 3 reasons to get in: reversal, congestion, exit, and continuation, and 3 to get out, which are reversal when something goes into congestion and a false signal. It's really that simple. Candle relationships and structure are important. That's not just that close in the top third of the candle. We've got improved results in over 80% tested. I think it's more than that, compared to no candle structure variable. And of course, the relationship to previous candles, because previous price action dictates price action. You've got a resistance somewhere. Then you've got lots of sell limit orders around that level, and you've got lots of buy stop orders above that level. That's what creates the line. And if one outweighs the other, then we get a movement. And volume is the heartbeat of the market. I don't give a monkeys whether it's tick volume rather than real volume. It's still reflected. And once again, over 80% of ones we tested benefit from a higher volume. The ones that tend not to, and that's just a higher volume bar than the previous volume bar. Once you start saying, well, look, it's above average volume, an average volume indicator, then you get over issues that might get in the way. So these 3 things need to be absolutely at the heartbeat of everything that you do. Those 3 strategies: continuation, reversal, congestion, exit. You haven't got those, you develop them, and this is where you start. Then, of course, we can look at other things like indicators. And that's when we come on to strength of signal. And this is number 2. We need to do some work on strength of signal. And that's a collective we, not just a you. Now, you already have the best indicators of strength of a move with volume and the structure of the candle. Okay, but when we're looking at strength of signal, we're talking about the degree of confidence and reliability that a trading signal gives us a higher probability move in our desired direction. So it's important because obviously its major application is to enter or not to enter. Arguably, you could use it for exit as well. But at a deeper level, and for those of you who are less experienced, then what you're looking for is a minimum strength of signal to say, I'm in. So it would be the price action, discuss the volume, and where the candle sits. That's a strength of signal. That's where you should be starting. Nothing else is needed. Everything else is fluff. Okay? Or making things easy to read. Once you move beyond that basic starter level of trading, then you're looking at, well, how can I make things better? Logically, if you've got a stronger signal, it could influence the size of a position. So a weaker signal could be saying, well, look, it's strong enough to merit a position, but I'm going to make it half size. Or this is a magnificently strong signal. Maybe I'll go more than my standard position size. It could create the decision as to whether you accumulate into an existing position or not. So by that, I mean, if you're already in 0.1 of a contract of the USD yen and you get another indication that signal is looking stronger, then maybe you add another 0.1 to that. And then later on, maybe another 0.1 to that. And then, of course, the absence of a strength, or the absence of strength, maybe is an exit signal, or even strength in the opposite direction, of course. So components, price action, as I've already said, and I want to keep on reinforcing this because it's so important. always number one is price action. It's live. It reflects sentiment in the now. Okay, so candle structure, comparison against previous price action, volume, because that's a live reflection of market interest in a specific price and a specific time frame on a specific instrument. The context might be important. What I mean by that is sometimes when you get a big piece of news, and this is where perhaps average volume works better. Let's try and find an example. Okay, so we've got what looks like a double L or a head and shoulders type pattern here. Okay, now we're getting a strength of signal transmitting itself saying this is a great candle. It's breached that level. It's the close its low, but look at its volume. It's actually less. So maybe we're waiting for the next candle to get in because that would follow our plan. We might like that candle, but if it's not your plan, we don't get into this. If we're using this sort of volume, however, if you choose to use average volume, would it be any different? Let's have a look. I don't know. If it's not, it's still not. So we'll look at that candle again, and no, it's still under. So this is an average volume indicator. That's our breakout candle. You can see it's still under average volume, so it still will be the next candle. That's okay. If we look here, see what happens. Okay, so if you don't take volume into account, there's your breach. Here's your breach. Volume lower, very low potential there. Gives you around about 15 pips, then bimbles for a day. Okay, maybe we need to look at it again across to find a quick example. Okay, it's not an example either. It's a really nice entry. Okay, this is a good example of trend continuation. Goes up, comes down, goes up again, breaches the previous swing high. We're away. Whereas this one, okay, so there's a swing high to breach. You can see low volume and you can see very little of move in that. Anyway, you get the idea. Then, of course, we do have indicator confluence. So although most indicators, apart from volume and price, are lagging, they facilitate understanding and they add to price action decision making positively. Okay, so there's no doubt of the role of indicators, either to confirm, you can use an MA to confirm a long-term trend, you can use an RSI if you really want to determine whether something's overbought or oversold. Or previous price action in terms of whether it's near, whether the proximity of the next price level up is probably more important. Excuse me. Yeah, the Japanese rate rise was one of the biggest. Watch actually January for a Japanese rate rise again. The Japanese rate rise in July was probably one of the biggest. So it would seem if we look at this, so if we look at the combination of price action volume and some of the stronger indicators that would pick it off. I'm not a big one for divergence, but some people like it a lot. I think there's other ways of telling something's a strong or a weak signal. But it would seem logical for a score to be created, and a strength of signal score can then be used to make entry, accumulation, and maybe even exit decisions. So if you get a strength of signal going from a high where you entered it to a low, maybe indicative of saying, hey, look, this is not only is not a new entry, it's actually potentially an exit. So does that sound like a good idea? Is if we created a strength of signal score that said, look, this is a strong entry, this is a medium entry, this is a lower probability entry, do you think that would be useful? Yes or no? Put it in the questions box. Let me know what you think. Okay, lots of yeses. I think that's fairly common. Nobody's saying no. Okay. Cool. Okay, so is weighting necessary? So logically, I made a big deal about price action and volume. And it's a fair assumption to suggest that that may be a major sort of influencing factors, and maybe more weighting than perhaps whether a moving average cross is a good thing or not a good thing. Yeah. So it could look like that, like this. I mean, these are just numbers pulled out. So evidence of sentiment change, that would be your moves from congestion up to uptrend, from downtrend to uptrend, i.e. in reversal. That would be, so that's what I mean by change of sentiment. Candle structure, maybe 10%. Agreement on high time frame, 10% volume, 10%. Then proximity of key levels, that should be, and then momentum. Volatility change. Usually there's a volatility change with any strong move, which is a good tick, and then event proximity. Obviously, is a key issue. So if you had a score that sort of worked out all these things, it could give you a final score, let's say out of 50, and say, right, okay, it's got to be above 25 to enter. Above 35 is a strong entry. Above 42 is a very strong entry. Hence, I'm going to position size 0.1, 0.2, and 0.3 accordingly. Does that make sense? So I'm not sure whether this is the best approach to weight it in percentage terms, but you could have a 1, 2, 3 grade. So if it's present and it's strong, it gets a 3. If it's present and it's medium factor, it gets a 2. If it's present, such as the volatility change and momentum, then it gets a 1. Makes sense? So there's a project there. I might put something on. Maybe I've got a poll that might suit it. I didn't put a poll together for this. And then, of course, there's allocation of scores to each action. So we're just giving you an example. So X score equals this action, Y score equals this action, Z score equals this action. So I think there's something in that. But as I said, your trading plan as a baseline should reflect a strength of signal that says this is a high probability trade. And I've given you already the roadmap for that for those of you who are less experienced. Okay, so just in trail stop parameters, and got a bit the system got a bit excited there. So there's no doubt at all that trail stops are system locking in profit, but do we have it on the platform or not on the platform? We need to recognize that what works for one might not work for another. And if you don't measure it, you're never going to know what works and what doesn't work. So if you're not using a trail stop at all, what I want you to do is go look at your last 10 trades, stick a 20 EMA on it, and say, right, okay, if it closes beneath the 20 EMA, I'm out. So let's say that you're in on this breakout trade here. So if it closes beneath the 20 EMA, we're out on that candle. Okay, that's what it is. So go back to your last 10 trades, look at the exits you actually took versus these exits and see which creates a better result. There's a mission. If you are using trails, time to look at some of the stuff. It's automatically going forward. Why are you doing that? Okay, I know why it's doing that. Okay, gonna. If I did not use trail, I believe you'd be better off. It's more of a feel good, safe factor and profit maker. Find the evidence. Yeah, I absolutely agree, Michael. I think that the grading is the answer. That there's probably a number of factors we can take into account, but the grading for the strength of signal, I think, is the right answer. Test that. You've got the ability to test that, mate. Just take all the trails off your EAs that we've been working on. Look at the results. Feedback. So this would be where it would be if it was a touch, and this is why I say close. If it was a touch, we'd be out here. Let's say we entered here, we'd be out actually on this one here. it touched there, it touched there. This would be the one we are actually out at. This is why we see close. Close is better than touch, but of course, you've got that catastrophic candle, so it's always worth having a safety net in there of some description. So in a lot of the EAs, we have something called a handbrake, which actions if there's a longer than normal candle. Right. Okay. So there's a couple of ways you can do this. Part of the problem is this. So this example here that I give you of this GB pound, yen. Where was the trade I pointed out? This is the trade I pointed out. So what happens is this. So now there's, on this hourly chart, there's 145 pips in between our stop and our 20 EMA. Okay. And so if at that stage we said, right, okay, if it exceeds a particular amount, then we need to tighten our trade up maybe to a 10 EMA, which is this. So at this point, we're looking now for a close beneath a 10 EMA. That might do it. Okay, so if we look at that trade, so remember our exit at this stage is there. Okay, if we at this point said this is too far, we're gonna now move to a 10. It's going to close. It would certainly happen there, and it might happen there. Both of these are better than this one here. So we could have a system that tightens the trail if it gets too far away, as we get with a fast price move. The other thing we could do is if we just mark this entry, which was there, mark this exit, which was our original exit was there. Okay, so the other thing you can do is you can tighten it up automatically by using it. If we look at this bit here, let's say we're in this trend. Let's say we're in this trade here. Okay, I'm going to make it blue so I can differentiate them. So blue is the, there we go, it's the exit. Okay, so there's our entry, there's our exit. So if we were on an hourly chart, then our exit would be this one here. Okay, so our exit would be at 196, or let's say 197. Okay, if we tighten the time frame up for 30-minute, our exit would be there, 197.59. Okay, was the close on that candle. So that would be 60 pips better off by altering the time frame to the downside. So we're keeping the 20 EMA. We're just moving from an hourly chart, which would be our primary time frame, to a tighter time frame because the distance has got too great. So that's another thing you can have a look at. So two things with trails: you can either tighten up the trail on a specific signal, or you can on the same time frame, or you can reduce the time frame. Both those will be good. So let's say that here we have an 80 hour. You could do it by risk level. So this is RMS. So if our risk level was 8 cents here, and it was over 2 times risk level, then what we do is we use this 10 EMA as our exit, not our original 20 EMA as our exit. So that would be 17. So that's 17 cents. That would be an out of 137. Sorry, 138. That would be an out of 128. So you can work out what 10 cents on a 128 position is. 6% better off by having a system that says if it gets 2 times risk, more than 2 times risk, which 17 cents would be between our trail and our current price, then we're going to tighten our trail up. Doesn't matter how you do it. I thought we'd give you that. That was a stock example for those who just trade stocks. So here is, so current price, maybe more than 2 times risk level. Either shorten your MA from a 20 to a 10, 15 to 10, or shorten the time frame. It may be that there's one that's better than the other, depending on which time frame you're shortening from. The other variation is obviously have a multi-exit strategy. So So you have an exit strategy which says, if any of them happen, then I'm going to get out. Let's show you what I mean. I'll try and show you at EA. Let's do one of the ones you've been working on, guys. Okay, so if we look at here, so this is an EA which is a zigzag, so based on a trend continuation. Just one of the, I think there's about 8 instruments it works on. Is the Canadian dollar yen. So this is 0.1 of a contract. Okay, so measly number. And this is working on an hourly time frame. And look at all the exits that are in place. Okay, so there's a partial close exit. That's true. There's a time exit. That's true. There's a last bar setting. So that means it's the lowest. It's the lowest bar in 5. Closes it. There's an MA exit setting, and there's a take profits stop loss, and then there's a handbrake in case of the big candle. Okay, so that's a multi-exit setting. Not hard, but ping me a direct message, Tom. I'll make sure you've got it. 9.3. I think you've got it in P4 chat. But ping me a direct message anyway. I'll make sure you've got it. So that multi-exit approach. Do we care which one's triggered? No. We care is the results we get. And the results we get, remember, this is 0.1 of a contract, okay? So this only trades Wednesday, Thursday, Friday. It's $1,500 for essentially, what's that? It's about 13 times net profit. And this is what it looks like over the course of time. Does that look nice? Yeah, guys, I've got this. If you choose to use it. You help work on this, Gunnar. So damn well it should be nice, mate. Hey? So there we go. Okay, so as I said, 0.1 of a contract, right? So that's an investment again and again. I don't want to bang on too much about EAs. If you want EAs, you can talk to me. Specification on Canadian dollar yen. 0.1 of a contract. Okay, so a full contract would be $1,116. You're entering 0.1, so $116. So in 2 years, which is a test, that was over. November till December this year. What did I say? $111. So $111. I worked that out. Something like 800% return in 2 years on that investment. Is it one trade at a time, just to make sure? Maximum trades 2. Okay, so it might be double that. Right. So we'll come back to that. As I said, that was just one of many that were picked. You can see from here. And we even test it on NVIDIA, we test it on Bitcoin. Bitcoin's an interesting one. Okay, let's check on this one. So this is Euro USD. Same, different settings. So you can see this hasn't got that handbrake in. It has got obviously it's got our last bar, it's got our time exit, it's got our partial close, still active. $2,000 profit for 174 drawdown. Let's look at the graph. Yeah, that looks pretty good too, doesn't it? Anyway, there you go. Ping me direct message in Discord, John, please. Right, okay. So back to the plot. So multi-exit, I would suggest, is the way to go, but do it one at a time, okay? We start with a trail of some description, and then add exits to that. Okay, the momentum graph. Here's one more strategy. Just I think is going to be particularly of interest when there is a. This is going to be one of the major influences of artificial intelligence on trading is going to be I think going to be a greater number of trades happen when there's a trend in play. And then once a trend is finished, then it's time to get out. So this is exploiting the psychology of a trend. I'm calling it momentum grab. There is an EA on this actually as well. So this is using the highest probability of the trade, which if we look at the short trade is between here and here. So it's when the momentum starts to occur, when people get excited about it, and then when it finishes, when people think, oh, it's time to take some money off the table. If we look at this long trade, this one here, you can see this is reflected in the MACD. So we do have already, we have this breakout. This is where the momentum increases and we get that, if you like, bandwagoning, for more of a better term. And you can see here momentum is just starting to wane a little bit. You can see that by the signal line. And so as soon as, but you can also see that by the histogram. So why are we waiting? If the momentum is going, why don't we just nick it off that when people are starting to take profit? So we are taking advantage of the bandwagoning and we're not messing around to the end of the day. So let's just have a look at some charts. Somebody suggest a chart. Any chart you want, we'll find an example. Any chart you want. From your call. So I'm pulling fictitious charts out my backside. Okay. Euro Aussie. Had a look at the Euro and Apple. Okay. There's a couple to start with. Okay, let's look at Apple first. Let's look at this as a concept. And so what we're going to do is we'll get rid of volume. Volume's tricky on daily charts, FYI. But we are going to look, we're going to stick our MACD on here. We'll use a standard one just so you don't think, again, I'm being tricky. Okay, so here is an uptrend. So what we're doing here, we might get in on this candle here. So we're going to do it at least, there's got to be a sign. That's a sign. There's got to be at least 3 momentum bars here, one after the other. Okay, so we're in this trend. Right, there's the first bar to the downside, so we're out. There, we're not waiting for the signal line, which happens a couple of bars later. We're just getting out of it. So there's our first trade. Okay, so we've done this. 1, 2, 3. We're going to be in here again. Maybe. We're going to be in on this one here. High volume. Third on there. Breach of the previous swing high. And then we're going to wait till there's one below. We're going to change this. We're going to change the color to a beigey sort of wheaty color so you can differentiate the trades. Okay, and we're waiting for, so we're in here, we're waiting for the first time one closes lower. And that is, so as I said, we're not waiting for the signal line. Come a couple later. So that is that one there. Okay. So that's trade 2. Okay, so we're waiting till there's another. Here's another one. So we're going to make this. So we're going to go 1, 2, 3. There wasn't enough short trade there. 1, 2, 3 will be this one here, and we're going to change this to, what have we done? Let's do greeny color. Okay, this is trade 3, and it's here. And then we're looking for the first time it's a decrease, which is this one. So the histogram, which says the moving averages are coming closer together. That's all the histograms tell you. Is that one there? So out on this candle there. Just want to make sure I've got it in the right line. Okay. I've got to trade. You stupid man. Okay. Yeah, that's fine. So we've lost our purple one. Let's put on another one. Let's put on one here. There's our entry there. Was this our purple one? Let's trade it, hasn't it? Okay, let's do it from here. Because we would actually be out here. Okay, so 1, 2, 3, we're up there. And now went for the first one below, which is this one here, which is there. So there was our purple one from before, and then we've got 1, 2, 3, 4 successful trades out of 4, so 100% on that. So what it's doing, as I said, is nicking the middle of a trend. So it's saying, yeah, this trend is established, let's get in. This trend is established, let's get in. This trend is established, let's get in. But let's not hang around in this. Let's just get out. Isn't that interesting? Who wants to have a look at that? There's Apple. Let's just quickly. GB pound was it? I can't remember what it was, David. Sorry. Do you mind if we do it on this one since it's here? Because I am conscious of time. Get rid of the other stuff. Or of course you just use it as an exit, of course. Okay, so it's a bit choppy, isn't it? So let's choose the short one. So we need 1, 2, 3 bars in at least. Whoa, too late. Way too late. We'd have another strategy picking that one up. Okay, let's do this one. 1, 2, 3 to the upside. Two, 3 to the upside there. There we go. Sorting on this candle here. And then we're out on this candle here. So there we go. We've nicked some pips off the market, maybe 18 pips there. It works on any time frame, so we could do this if you wanted. So we'll go 1, 2, 3. Actually, we could even do here. No, that's downwards. 1, 2, 3. We need 3 upwards, and then we're out. Out on that one there. So slightly different entry. That's the 1, 2, 3 upside. So we've been the candle before. So we've been on this candle. So we've scooped 36 pips from that just by picking the middle part of the trend before people start getting twitchy about getting out and after there's some bandwagon coming in. So there you go. Have a look at that. There is another alternative, which is the SAR alternative, which essentially works on the same thing. I might do a session. If you like the idea of me doing a complete session on this, we can have a look at it next week. But essentially this works on finding the last series downwards and saying, right, okay, we're in because the price has breached that last series to the downside, that last downwards. We're not actually in it very long on this one at all. It's not a very good example. I guess that's a low volume example. Okay, so in here, so the trend has already started. We can see that by the SAR, but we're using this here as our entry, the top dot of the series. And then we're trading this until the SAR switches over. So there's the point at which it slips over. So we'll be making this profit here. So again, if we look at this, what it's doing is saying this trend has started. This trend looks as though it's a little shaky. It's losing a bit of steam. And indeed, we would have seen that on the MACD as well. So, but it's just using the parabolic SER to fit the midpoint of that trend. So we're not trying to trade here because it's not high probability at this stage. It's high probability once it breaches this last series to the downside. The only issue with this is you've got to have a couple of other parameters in this, to get over this chop, chop, chop stuff that often happens with the SAR. So go and have a play with those two. Is that good? Who's going to have a play with it? Say yes in the questions box if you're going to have a play with that. Okay. Cool. Okay, so wow, look at the time. Okay, I'm going to whiz through it. Okay, if you want next week's session to be on the parabolic SAR and how to use it for entry and exit, type in please. Or no, just type in SAR, and I'll know that it's worth doing. I'll make that. So that's number 4. Number 5. Okay, there's already 15 SARs, right? I think that's next week's session. Right, okay, so scaling and planning. Once you have a successful system, you need to, and how do you know you've got a successful system? You've got reliability of self, i.e. the ability to follow a plan and the reliability of system. And then you can start to scale. And this is the approach of actively increasing the size of the positions you take. And this should be planned. There should be a scaling plan within your overall trading plan. The problem is, or problem number 1 is most traders don't know how reliable the system is, because they don't trade it with all the time. And secondly, they don't know it because they don't measure it. So there's a couple of things you can be doing straight away. So what can you do? Okay, types of scaling is you can do a fixed lot size. So you trade the same lot size for every position. You can use fixed fractional scaling, so you trade a fixed percentage of your account, so 1% risk of your account. This helps manage risk quite well, and just for account size, so that's better than the first one. The third one is selective strategy scaling. So you base your lot size based on the demonstrated success of a specific strategy. So right at the start, I talked about 3 strategies. We talked about a breakout strategy, we talked about a trend continuation strategy, we talked about a reversal strategy. So you should have a strategy for each of those. If you haven't, there's a great thing to put into place. And there's all sorts of reasons why you should do that. Not least the fact that you're not missing out on opportunity. And secondly, you're quite happy to take a profit at a resistance level rather than being caught into the FOMO. Because if you've got a strategy, a trend continuation strategy, you're in again anyway, so it doesn't matter. And if it doesn't continue on, then you've closed your position and all's good. Anyway, back to scaling. So what you were saying with selective scaling is that you're maybe, when you look at your 3 strategies, you see your breakouts, okay, maybe 55% win rate, maybe your trend continuation is 65, maybe your reversal strategy is 40%. So you know which one you're going to, logically, the one you should be scaling first is the one that has the best results. Then, of course, at advanced level, you can look at variable scaling, which is another story for another day. As a beginner, what you tend to do, and that's okay, is across the board scale. So you're getting generally good results with your 1%. Now, this is different from your account size getting bigger and bigger as you do well, and you're still trading 1%. This is an active decision to trade more than 1%. As an intermediate advanced, you should be looking at selective scaling, but you should have some reasons to take action. And first of all, you need to specify the minimum number of trades. And then, of course, you can look at win rate, profit factor, drawdown, risk to reward ratio, which is your net profit to drawdown at any stage, and your Sharpe ratio. When we look at EAs, we're looking at risk to reward ratio, unfortunately for this. Unfortunately for you, because you can convert most of your strategies into EAs if you really want to. Okay, so if we look at this, if we look at our back test here, we've got our net profit. This is the major thing, net profit to drawdown. When we first started doing the A's as part of the program, we were looking for 4, 5 to 1 net profit to drawdown. Now we're looking for over 10 to 1. As you can see here, that's 12, 13 to 1-ish. We can see here that it's based on 45 trades, 89 if you're in and out. One obviously hasn't closed yet. Or maybe it was a partial close. You can see a 62% win rate, but win rate isn't all that. What's as important, the three, if you like, the triangle is win rate, average profit, average loss. But you can see here that your average profit is more than double your average loss. Okay, so that is 62% when you've got 2 winners per 1 loser is what creates £2,000. Now we can scale this if you want. This is what I look. Tell me. So tell me roughly, if you're trading a CFD, what would be your average risk? This is 0.2 of a lot. What would be your average risk in dollars? Per trade? Give me $1,000, $100. We've got $60, $20. Okay. So what we'll do, if we look at the average risk, that's your average loss, isn't it? Because there's always going to be times when something smashes through your stop or whatever. So let's say your average loss. So let's say we'll double that. Okay, so this is our loss because this drawdown is created by 3 trades consecutively that just don't go our way. So let's up this to 0.5, shall we? So this is what you normally risk on a trade if you risk $150. Actually, you're risking $120 a trade, essentially. And you're making $5,000 in 2 years just on this one strategy. At some stage, it'll pull back. You'll get 4 trades which don't go your way in a row. But you know when it does go in your row, 256 to 118, so more than double. Yeah, absolutely. I get you completely. And yes, you've got to multiply that by, so when you take into account risk, you've got to multiply your overall account risk by the number of positions you have open at any time, which you should also have written in your trading plan. So you can get all those figures. It's really easy. So key considerations is when you are scaling. So once you've decided what you're going to be your criteria to scale, what you're going to be actually scaling on, you've got some psychology to deal with. It's worthwhile doing it in such small increments. You wouldn't jump from 0.2 to 0.5 as a there. You'd probably go to 0.3, then to 0.5, then to 1. It's worthwhile having a demo account, which I would call a ghost account, which mirrors the trades exactly, but trades at a bigger lot size, so you're used to the size of the numbers. You're used to $100 profit and $50 loss, and all of a sudden you see $100 loss. It's going to hurt. You're going to get panicky, and you're going to get out before you should. Likewise, if you're used to taking $100 profit and it's at $200, you might take that prematurely as well. So getting used psychologically to the bigger numbers is what you can do with the ghost account. That tells you, well, this is what I would have won. It's also motivation to get out of the procrastination state that many people find themselves in. So it could be used as, yeah, it's okay, these numbers are what I expect, or it could be used as the stick you need to take some action in 2025 for those strategies which are demonstrating on a regular basis that you are doing well. So that covers a multitude of sins quite quickly, but I wanted to give you 5 that I thought were game changers. Different actions at different levels, obviously. And of course, a couple of projects there. I did think of the idea maybe of, I'm not sure I could do it within Go Markets, but I could do it with my other entity, of maybe doing a scaling project 1 month where we actually nail it, and maybe take 6 weeks and look at putting together a scaling plan together, testing out, do that using the A's and stuff, just for record keeping. And do another one where we look at strength of signal and actually test, come up with a scaling score, and then test that subsequently. So I could put it together. I'm sort of a busy bloke. Let me know if you want me to put something together. Here's a poll. I can even have a talk to Go Markets about it, actually, and see if they'll pay for my time to do it rather than you guys paying. Wow. Okay. Well, I think that's pretty conclusive. Thank you to, yeah, let's find out more. Okay, so there's half of you voted. 89% sound great, 11% need to find out more. I'm assuming if there wasn't a cost, you would be 100%. That might be the more you need. Look, if it was going to do it, and if it's outside of Go Markets, then it's going to be a cost. It's going to be no money. It's not going to be much. But I might try and persuade Go Markets I need to do this. Just paying me for time just as an alternative. Wonderful. Thank you very much for voting. Your participation is always wonderful. Thank you very much indeed. Right, I'm going to close that poll down. Thanks to the 55% of you who voted. It's really, really cool. Okay, so your actions from this session. I hope I've given you some things to think about. What I want you to do is list 3 things that you are interested in doing for yourself after this session's finished. Do it, write them down, and then make them happen in 2025. The recording can be available. You have to drop me an email. Ask yourself, how can any of this stuff contribute to my trading, and put some things in practice? Remember that question I raised right at the beginning. You've got a choice, really, guys. You can take some action or not take some action. You know the probable outcome of either. What's really been very cool today is the amount of participation, is the amount of comment. It's been wonderful. Thank you very much for that. It always means that it is a create less, make more dollars, have fun, absolutely gonna. And most importantly, yeah, you've hit the nail on the head. As well as take some action to create your trading future, what's most important in 2025 is that you have a happy, healthy, prosperous emotionally as well as financially 2025. I'm blessed with having a regular group of people who pop along to hear me share some stuff from my good times and bad times. You've been wonderful to be amongst over the last 12 months and the previous 4 sets of that beforehand. So I love and leave you. I wish you all the very best for the year, and I look forward to being part of that. So we'll return next week to a normal Wednesday session where I promise to follow through and do the parabolic session for you. And obviously, if you're new to this and want to pop in, we run lunchtime sessions. You're very welcome, where we just look at the charts of the day and what's happening in the market. So a bit of headlines, a bit of charts of the day thing. You're very, very welcome to that. Pop along to that. So it'd be great to see you there if you can make it along. If you don't make it along regularly, it doesn't matter. It's a one registration covers all. I'm going to put that link into chat. Drop me an email as well. So that link's in chat now. You're going to pop me an email about anything that you heard tonight. I'll put you my Go Markets email in just because that's what I should be doing. Okay, let's try that. Mike.Smith, yeah, at gomarkets.com. That's correct. Right, pop that in as well. So you should be good. Should be good to go on the daily live update. And as I said, if you pop along to 5 or 1, it doesn't matter, per week. You're always registered. You'll get a reminder. And of course, let's just have a pop back at our charts today, shall we, before we leave? I can't remember what they were. What were our charts of the day? GB pound Aussie still looks good. That looks good for a move back up to 202.34. Ba-ba-ba-ba-ba-bum. You too, Ewan. Thank you very much. Thank you, Paul. You're a legend. I know, me too. It's gone really fast. Jace, it's a pleasure and privilege to have you part of this gang. You having issues with cut and paste from Windows to Discord? Try a snip tool, Chris. If you go into your search button here, type snip, and this snipping tool. So you type on new, and you can snip anything you like, any area you like. There we go. And then you can just copy that. Multiple screens open, just copy that. And then you can just paste it straight into Discord. Try that snip tool. That might be a good thing to do, mate. It's a wonderful piece of kit for something that's free. Free and wonderful are two good things we like. Anyway, that'll do for now. Take care. Enjoy your New Year's Eve. Most importantly, have a wonderful 2025. Catch you soon. Bye for now. Windows logo on Shift plus S says Gunnar as well, by the way. Trade safe and see you again soon. Bye bye for now.